Washington capital gains and estate planning interaction. You've worked hard to build your investments, your business, your future. But here's the shocker for Washington residents. When you sell assets like stocks, bonds, or even a business, you may now face the state's capital gains tax up to 7% on profits above a certain threshold. That means your lifetime of growth could get sliced away by taxes. And when you combine Washington's capital gains tax with the estate tax, the impact on your legacy can be devastating. The good news, with smart estate planning, you can reduce, manage, or even avoid unnecessary taxes and keep more wealth in your family. So today I'm breaking down exactly how Washington's capital gains tax interacts with estate planning and what strategies you can use to protect your assets in 2025. Hi, I'm Jason Gray, an estate planning attorney here in Washington. Every year I meet families who are surprised by just how much state taxes can erode what they've built. Not just federal taxes, but Washington's unique combination of estate tax and now the capital gains tax. In this video, I'll explain how these two systems overlap and why ignoring them can cost your family thousands, and the planning tools that can help you stay ahead. Let's get into it. What is Washington's capital gains tax? Let's start with the basics. In 2021, Washington enacted a state-level capital gains tax. It's a 7% tax on profits above a threshold, currently $262,000 for individuals. It applies to long-term gains on things like stocks, bonds, and business sales. There are exemptions. Real estate is excluded, as are retirement accounts and some small business sales if they meet specific conditions. But for many Washingtonians, especially business owners and investors, this tax is a real factor. Now here's where it gets tricky. Washington also has its own estate tax. The state exemption is $3 million, which is far lower than the federal exemption. That means many Washington estates face tax exposure. Capital gains taxes during life, estate tax at death. It's a double hit unless you plan ahead. How capital gains and estate planning interact. The step up in basis. At death, most assets receive a step up in basis. That means that unrealized capital gains may vanish, potentially avoiding Washington's capital gains tax. For example, if you bought stock at $100,000 and it's worth $1 million when you die, your heirs inherit it with a cost basis of $1 million, eliminating capital gains if sold immediately. That makes holding appreciated assets until death rather than selling a possible strategy. Estate tax still applies, but here's the catch. While capital gains may be wiped out at death, the estate tax doesn't disappear. Washington's estate tax could still apply if your total estate exceeds the exemption. Assets can escape capital gains, but still face up to a 35% estate tax. Lifetime gifting. Some families think gifting assets during life avoids both taxes, but gifts during life carry over the original cost basis. That means your heirs could face capital gains taxes when they sell. In many cases, it's smarter to keep the assets until death, secure the step up in basis, and let your heirs sell tax-free. Trust strategies. Certain trusts can help manage these taxes. For example, a grantor trust can preserve the step up in basis while still achieving other planning goals. A charitable remainder trust can allow you to sell appreciated assets without immediate capital gains while providing income and leaving a gift to charity. For business owners, transferring shares into trust before a sale may reduce both estate tax exposure and future capital gains. Coordination with federal law. Remember, Washington's rules still sit on top of federal law. Federal estate taxes could also create more of a burden for your estate. Washington residents need to plan for both state and federal systems working together. Here are the biggest mistakes I see. selling highly appreciated assets without considering the state capital gains tax, gifting assets that should have been held for the step up in basis, forgetting that Washington's estate tax exemption is far lower than the federal one, and most of all, failing to coordinate capital gains, estate, and income tax planning together. Taxes don't operate in silos. Your strategy has to account for how they overlap. Your plan shouldn't be static. Review it every few years, especially if you have major changes like selling a business, buying new investments, or significant estate growth. Laws change, exemptions rise or fall, and Washington could amend its rules. Pair your estate plan with tax strategies, succession planning if you own a business, and retirement planning to make sure everything works together. You've worked too hard to see your wealth eroded by state taxes. By understanding how Washington's capital gains tax and estate tax interact, and by planning ahead, you can protect your family, preserve your business, and keep more of what you've earned. If you're ready to create a plan that reduces taxes and secures your legacy, click the link below to schedule a consultation with us today. And if you found this video helpful, check out my next one. YouTube thinks it will give you even more tools to protect your wealth here in Washington.